This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go! Hello, and welcome back to the Fintech Takes podcast. My name is Alex Johnson, and this is the first Bank Nerd Corner of 2024. So, as always, we welcome back the marvelous, the wise, the fast-speaking Kiah Haslett, banking and fintech editor at Bank Director. Kiah, Happy New Year.
Oh, Happy New Year to you too, Alex.
Thank you. I appreciate that. How's 2024 been treating you so far? Is it weird to say? Is it weird to write? I was going to say, is it weird to write on a check? But you probably haven't written a check in 2024 yet.
No, but as a journalist, it's really, you have to remember when the year changes and be really specific, because now if I'm talking about anything that happened more than 2 weeks ago or 3 weeks ago, you have to say it's in 2023. And then going forward to think about, oh, I'm in 24 now. The next year is 2025. But personally, in Nashville, we're reporting live from Nashville. The Music City has gotten more annual snowfall, or like the average snowfall in 24 hours than it gets all year. And so I am snowed in. And as a Nebraskan, it's very funny to look at how just other states just lay down and do nothing when a bunch of snow falls from the sky. What about you?
Yes. Well, right. So, okay, you're a hardy Midwesterner, right? And so, you probably had the same experience I had growing up in Montana, which is, you get your ass to school, and it does not matter what's going on, right? I think there was one day in my 18 years of public education where we didn't go to school. We got a day off, and it was because it was so cold. And this is the old days when, vehicles were less reliable maybe than they are today. But it was so cold the buses wouldn't start. And so it was more a logistical challenge of how do we get the kids to school. It wasn't like it's too cold or there's too much snow. And the problem, of course, is in Montana or Nebraska or places like that, real places, let's be honest, they don't build any extra days into the calendar. And so I was like, oh, snow day, this is amazing. And then I had to make it up in June, right? Because there were no slack days built into the calendar. And so it doesn't get you anything. So anyway, it's been very cold here over this weekend. And late last week, we got down to negative 37. That was the low.
Oh my gosh.
Which is very cold.
Yeah.
And I think the Friday before the weekend where we did have school, so my eldest son is in kindergarten, when I dropped him off, I think it was negative 25 outside.
Oh my God. Wow.
The concession that they made was they didn't make the kids wait outside and they let them into the school early. And, I don't remember them doing that when I was a kid. So even that we're getting a little bit soft on. But that's been the winter storm experience up here.
I'm realizing that although I feel comfortable with a lot of the snow, that when I live in a place that doesn't invest in just plowing the streets, or doesn't pre-salt them. And also, I will say that I grew up in a really flat area, and Nashville has a surprising amount of hills. It does make me feel like, oh, I don't want to be on the road right now, or I have no reason to be on the road. Yes. And so infrastructure really plays into my ability to interact with the environment comfortably in a way that I didn't appreciate growing up. When I was driving home yesterday, I was literally like, so is the plan to not plow the streets? What part of the snow response plan does not plowing the streets fall under?
It's the first plan. It's the only plan.
Yeah. The plan
that
A,
is hilarious.
B, and C.
It's just, we're not going to plow. Well, what are snow plows might be the question. Yeah, no, I mean, I think that's a really good point. And actually, we won't go down this rabbit hole anymore because that's a perfect segue to the first of our many news stories. So we, as always, are going to start by bouncing around a couple of things that have happened over the last month and a half. I feel like a lot of banking stuff has happened since we last recorded. And then, as always, we'll dig into some questions that we're sort of curious about, but probably can't give good answers to. And we'll give Kiah an opportunity to rant at the very end. So, Kiah, speaking of infrastructure and the surprising role that it plays in how things work, can you give us an update on the bank rescue program, which was something that we talked about last year, I believe?
We have talked about this. Its formal name is the Bank Term Funding Program, but I like to think of it as a not discount window. And that's because it is the Federal Reserve's emergency liquidity facility. It was set up after the liquidity crisis that was kind of kicked off with SVB, because very specifically, the concern was if uninsured depositors started pulling their money out of banks everywhere, there wouldn't be enough lending capacity from the FHLB, which is many banks' preferred secondary liquidity provider. And to incentivize banks to use this not discount window, the Fed allows you to doesn't make you take the discount on your securities that have lost value. So the funding is done collateral at par value instead of the discount value. So it's actually like it should be more financially attractive from the collateral perspective. And the reason why it's coming up now is, one, it's within 3 months of its targeted end date. This was a 1-year liquidity program, but also the market has priced in that long-term interest rates are going to be lower than they currently are, which is presenting like a nice arbitrage opportunity for banks to make a little money with a pretty risk-free borrow from the Fed at, I think it's 4.7 today, and then put it into your reserve account also at the Fed at 5.4. And these are kind of decisions, or like the 4.7, that's a market-based rate. That's why this arbitrage exists, because the Fed is successfully indicating and people believe that long-term rates will be lower a year from today. And so banks are kind of taking advantage of that discrepancy and borrowing from this discount window before it winds down. And, that's probably not what it was intended for. But I think it's fine that banks are doing this. I think it's fine to make a little risk-free money. Banks are not making a lot of money right now. And also I think it's good that banks use this facility, especially because, many of the things that led to SVB needing to restructure their balance sheet actually still exists, whether or not we have that liquidity urgency. Still, I think banks still need a lot of different funding sources. And I think it's good, to incentivize them to borrow from the Fed rather than from the FHLB as emergency backup liquidity. What about you? I mean, do you like this trade?
It's a good, risk-free. Always take risk-free money, right? I agree. The Wall Street Journal headline was the Fed launched a bank rescue program last year. Now banks are gaming it. And, it's a good headline, but I agree. I don't think there's anything super unusual or all that bad necessarily. And I like that you mentioned the non-discount window, discount window way of framing it, because as we talked about, I think last year when SVB and everything was going down and we were talking about what are the sort of emergency liquidity sources that banks can turn to when they need it, there is this very strange reluctance to lean on the Fed discount window, right? And part of it is, as you were saying, the collateral. Part of it is just, it's like a bad reputational thing, right? It's seen as like literally the lender of last resort. And if you're using the lender of last resort, then you must really be in trouble. And so it has this weird stigma, which you've talked about a lot on the podcast, that probably shouldn't exist because, these things are designed to be used when you need them. That's the whole point.
Yeah.
But it still does exist. And so I kind of wonder, more psychologically, almost from a bank and investor perspective, if this might be a helpful bridge to kind of helping everyone in the industry remember, these things from the Fed are designed to be used, and it's not a sign of imminent doom if someone taps into these when the environment is, appropriate, right? I kind of think of it, to your point, what the sort of consumer equivalent is. It's kind of odd because all of this stuff is coming from the Fed, right? And so it'd be if my bank is, paying me, 5% on my savings account, but then they're also just giving out money at a lower interest rate that I can borrow from. That would be a weird thing for my bank to do, but no one would blame me for taking advantage of that trade. And I think that, just the use of these facilities generally feels like something that we need to normalize and kind of get back to a better balance on. Because, the other thing I did not know before SVB melted to the ground last year was that the federal home loan banks play a shockingly important role in backstopping a lot of the liquidity in the banking space. And as you and I have talked about before, it's not exactly what they were designed to do, and they don't work perfectly really for everyone under any circumstance. Right. It's a the degree to which they were using those almost exclusively was a misuse of what it was set up for. So I'm all for let's kind of diversify the options here a bit.
And I hope that, concurrent to the bank term funding program, non-discount discount window, the Fed actually has spoken, governors have spoken about banks using the discount window and saying, we believe that this is an important part of secondary liquidity. And, SVB famously wasn't connected to the discount window when they had their deposit run. And so I'm hoping that, if you're a bank that's taking part of this trade, that actually does help you test your capacity to borrow from the discount window. It makes you put collateral at the Fed and use it as a facility. So I do think, again, I kind of don't think the BFTP should go away. I don't think it should go away for as long as the rates are really high and as long as we're dealing with this AOCI liquidity situation. I don't think there's anything wrong with, for banks making a little bit of money off of the difference of these rates. But I do think that if the BFTP goes away, do banks go, move all of that borrowing back to the FHLB? Or have we successfully gotten rid of or lessened the stigma of borrowing from the discount window, and now you'll just move to the discount window? And we know that, during the financial crisis, there were times that the FHLBs had higher rates than discount borrowing rates, and banks still used them instead of using the discount window. So this is a pretty strong stigma. Price can't just erase it. So I'm hoping that, this is, I think the BFCP really helps stabilize the industry, really backs up, also remove pressure from the funding constraints of the FHLB. And then, I just don't think we're in such a radically different operating environment from March, 8th, 2023.
Yeah. No, I agree with that entirely. And it is weird how these things will go from being a crisis, we have to have this, we have to set this up, it'll be ready next week, blah, blah, blah. And then just with not even a full year removed, we're we don't need this. And the conversation totally shifts to one, not only is it over, but banks are gaming this, right? And I don't, I'm sort of mad. The more I'm thinking about this, the more I am getting mad at whoever wrote that title for the Wall Street Journal article. Because the problem with that framing is it sort of positions this funding mechanism the same way that the FDIC's charter for its insurance fund is written, right? Which is we don't lose money, right? And there is something sort of vaguely annoying about regulation for banks that prioritizes taxpayers not losing money over safety and soundness, right? Or maybe possibly at the expense of safety and soundness. And I feel when we say, oh, well, they're gaming this, it's they're sticking their hands into the pockets of taxpayers, taking money out and just laughing all to the way the bank. And that's not really true, right? And to the extent that it is true. Yeah, and to the extent that it's kind of true, it's a trade that I as a taxpayer am more than happy to make if it reduces the odds of these liquidity crises in the futures. Those things are way more expensive and disruptive to me as a taxpayer than whatever incremental pennies I'm chipping in to make sure that banks have adequate liquidity right now. So that whole framing kind of annoys me.
Well, and the other thing too, and I'm sure we'll talk about this next month, bookmark this, but earnings are going on right now. This is still a really challenging environment from an interest perspective. 2023 might have been the peak of net interest income, and margins might still be compressed if banks can't make higher interest loans to offset the lower interest. So it's entirely possible that in 2024 we have earnings conditions that kind of lead to zombie banks that are paying more for their deposits than they're making on loans. They're upside down, and if banks can make a little bit of money to kind of offset some of those pressures, that kind of just buys them some time for the interest rate trade to be fully unwound until we can get into 100 basis points lower, 200 basis points lower, and the deposits are cost of deposits equals the money they're making on loans. But to me, gaming is pretty loaded, and people are reporting very breathlessly about this. There's only $147 billion that have been drawn or were borrowed by I think January 11th. I think it's fine.
Yeah, I mean, the takeaway is calm down, Wall Street Journal. Okay.
Sorry, it was November 1. My bad.
No, you didn't November. Yeah, fair. No, totally fair. All right, so are you ready for our next topic?
Oh, yeah. I fell down a rabbit hole on this one.
No. Well, I mean, like, if we fell down on a rabbit hole on that one, get ready, listeners, because it's going to be even more on this next story. We'll try to contain ourselves. But, Kiah, I want to talk about ILCs. Are you ready to talk about ILCs?
Yes. Industrial loan charters.
Loan charters.
That's not something you thought about in 15 years. Industrial loan charters.
Which is like totally defensible, by the way, but we're going to talk about it because there was a report from Politico in December of last year, to your point, which stated that Senate Banking Chair Sherrod Brown is apparently in the process of reviving legislation to crack down on tech companies that want to get into banking. So essentially what this proposed bill would do would essentially ratchet up federal regulation of firms outside the banking industry that obtain these industrial loan company charters, which is a type of state-level license that allows these companies to expand into financial services. And what's interesting about this to me is that, well, first of all, as you might not be too surprised to hear, it's really been an effort that's been supported by a lot of folks in the banking space. So the Ohio Bankers League, the Bank Policy Institute, which represents a lot of large banks, the Independent Community Bankers of America, Americans for Financial Reform, blah, blah, blah. Everyone is sort of piling onto this effort. It also has a strange amount of sort of bipartisan support, which I was a little bit surprised by. I think anytime there's bipartisan support in Congress these days, I'm surprised. But Kiah, I guess the thing that I find sort of strange here, and maybe you can give us a little bit of the history, because I know when we were putting this outline together, you fell down the rabbit hole a little bit. But, ILCs are this weird thing that, yeah, seriously, they've been around for a while, and I don't know, they seem to come up over the 20-ish years that I've been working in this industry, they probably come up every like 7 to 10 years as sort of a hot button issue, and then they go away and then they come back. And I don't think the actual number of these chartered institutions is very high. So, like, can you explain to us, like, what is the scope of an ILC today? And like, where are some of these hot button issues over time?
Yeah. And I probably know a little less, but maybe I focus a little more on this because I've only been around for like about a decade. And you're right. Like, I kind of only learn about things as they pop up. And so I learned about ILCs with, Walmart attempting to get an ILC, and it's come up. Really the interest in these is kind of tied when companies submit an application for them. But what I have learned down my rabbit hole is that ILCs and industrial banks have been around since the turn of the 20th century. So at the start of the 1900s, these are specific banks that were set up to give loans and provide banking services to industrial workers. They are state chartered institutions, and right now the only states that offer these charters are California, Hawaii, Indiana, Minnesota, Nevada, and Utah. They are not banks, but they are basically banks that are owned by a company that's not a bank. And the company that is not a bank is not subject to the Bank Holding Company Act, which is where the Federal Reserve oversees the company that owns a bank. And I don't know if that's like a little confusing in banking. If a bank has a holding company, most of those holding companies are called bank holding companies. But right. ILCs are banks that are owned by a non-bank holding company or just a holding company. And they are not subject to the Bank Holding Company Act. They're not subject to the Federal Reserve. So this law would change that. You and I were trying to figure out basically, what the meaningful differences are for ILCs, and they can't accept demand deposits, and they have to have assets of under, like, I believe 100 billion, or right, 100 million. Sorry, it's not.
Yeah, 100 million. Okay, 100 million. Sorry. It's 100 million for the deposit account, right? So if they're over 100 million, then they can't offer demand deposit accounts, but they can offer now accounts. And can you explain what the difference is between a demand deposit account?
I can tell you that the now accounts are different. They are different products than demand accounts, but I can tell you that they've not had meaningful differences since, like, for the last 10 years, since Reg Q has been changed. You do not have to give 7 days notice that you want to draw money out. So that, to me, is distinction without difference. It doesn't matter.
So now accounts, now accounts used to be, right. So to that point, like, just to be clear, now accounts used to be a specific type of deposit account that was the only, like, deposit account that an ILC bank could offer.
I think it's still the case. Yeah.
Yeah. And an ILC, especially one that's over 100 million, right? And those now accounts used to, prior to, I think, Dodd-Frank, they used to have restrictions around functionally like how quickly you could take money out of your account, right? And so if the account offered interest, it was treated more in some ways like we used to treat savings accounts, where there was like a delay when you could take the money out. However, since the repeal of Reg Q, which happened as part of the Dodd-Frank Act, that essentially erased that requirement. And so now anyone who has an ILC, they can offer now accounts that work exactly the same as demand deposit accounts. And for the most part, my understanding is anyone who has an ILC that offers now accounts, that's pretty much how they work now, right?
Yeah. And so the lay of the land is that as of March 31st, 2020, there's only 23 ILCs. They have 165 billion in assets. 23 total. They have 165 billion in assets and 135 billion in deposits, which was at the time less than 1% of all FDIC combined total assets. Some of the ILCs, according to the Congressional Research Service, are owned and overseen by companies like UBS and Sallie Mae. And then non-financial ones are Toyota and BMW. Some are niche lenders. And so this law would impact them. And I suppose all of the 8 companies that have applied for ILC applications, depending on where those charters are. So Ford Motor Credit had applied for an ILC. Rakuten, the eBay company, applied for an ILC. Thrivent applied for an ILC, and General Motors had applied for an ILC. So this is the stakes that we're arguing about, is about 30 companies, whether or not their holding company should be seen by the Federal Reserve. And I think this is such a stupid fight, and this is kind of a waste of Congress, fixing addressing a problem that's not a big deal. And, I think that the history of ILCs is kind of the history of who gets to have a bank account or a bank charter, and who do we want to have a bank charter? Because in the past, we wanted these companies to provide these ILCs. There used to be, 50 ILCs, and now there's 20. But we didn't want Walmart to have an ILC. And so so when I say we, I mean society or... And so, that application was slow rolled. I don't think it was actually ever rejected. I think Walmart withdrew it. And so,
Walmart was basically told in no uncertain terms, no way in hell are you getting this, but we're not going to decline it officially. Right.
We're not going to decline it. We'll just always return it. And so, we've only had 2 ILCs granted since 2010, and those are Square and Nelnet. And, Square, obviously small business accounts, and Nelnet student lending. So, Alex, what are your thoughts on this ILC regulation, ILCs in general, the stupid now demand deposit account issue?
Yeah. Well, okay, so first, the now account, demand deposit account, is totally just a distinction without a difference. I think you're absolutely right. There's functionally no difference between an ILC and a regular bank charter, except for the big distinction, which is the one that banks get grumpy about, which is if you have an ILC, you're not subject to the Bank Holding Company Act. And just to be really clear about that, I mean, the problem for a Walmart or an Apple or whoever is they can't be subject to the Bank Holding Company Act. It's just not compatible with their business, right? And so if you basically said the only people who can have bank charters are ones that are subject to the Bank Holding Company Act, you're essentially saying, and, banks don't, say this out loud, but this is sort of the implication of what would happen. You're saying that no large non-bank corporation can ever be a bank, right? And I think that kind of going back to your point about as a society, what do we want and what's the outcome that we want to get to? The thing that bugs me about all of this is don't see any evidence, and maybe the folks working at the Bank Policy Institute can send me a letter and correct me if I'm getting this wrong, but I don't really see any evidence that ILCs have ever wrecked any part of the banking industry. I don't know of any instances where they've posed a safety and soundness risk. I think that some of the very largest non-bank financial services company, like a GE or something, did end up becoming systemically important in ways that probably are important to address in the future. But like, I don't know, to me, like, as you point out, there's not a ton of these companies. They don't, for the most part, do anything too crazy. You know, like Toyota participates in the captive auto finance market as a captive finance provider, and they provide loans to help people buy Toyotas. Like, that's in Toyota's interest. As a Toyota owner, it's in my interest. I benefit from it. I think the same thing is true with Square, right? I mean, it's a pretty narrow, focused bank that serves small business owners. And I think that, you know, in the case of Square, like, the question is, with adequate supervision, and they are supervised and regulated as banks. They're not regulated under the bank holding company level.
At the bank unit level, the state and the FDIC supervise them. And if they're insured deposits are insured. So
Right. It's not like they're completely unregulated. So they are regulated, and I feel like the benefits they provide to their customers are valuable to society. And I kind of feel like the objection here is more, you know, the special privileges that you get a bank in terms of like your business model and your ability to benefit from net interest margin and other things that, you know, only banks can do, the ability to access different payment rails directly, like all of the benefits of being a bank from a business model perspective. When banks object to ILC charters being given out, it feels not so much like a safety and soundness argument, but more just an argument around, we're the only ones who should get these special things.
Yeah.
And that to me, like,
fencing.
Yeah, like I totally get why they think that, but I don't know why I'm supposed to care as a consumer, you know?
Right. This isn't my fight. So
it's really not.
I had the impression that ILCs did not cause the financial crisis. So I just needed to fact check that. And so what I found was that Goldman Sachs, Morgan Stanley, and General Motors all converted their ILCs to become commercial banks. And then those companies also then became BHCs. And then other ILCs voluntarily closed, including the GE and Target ILCs, and then 2 small ILCs failed. So I don't know if that means, like, you know, it didn't sound like they fared better or worse. And also they had options that were available to them. I also think that this current regulatory oversight, quote unquote, exists because ILCs predate the Bank Holding Company Act. And so they were kind of grandfathered in. Right. And so it's not like super logical. And so I guess it could change, or I guess it doesn't have to change. But at the time when the rule was going into effect, that's not something that was seen as maybe super important or a big priority that the BHCA was supposed to address. But also, I think this kind of brings up, in a similar to how you and I were trying to figure out the now versus DDAs, like, why do we have so many charters? And why? And I think this kind of contributes to regulatory complexity, or these instances of regulatory arbitrage, where it does kind of feel like, I guess if I was a bank, it kind of does feel like someone's getting away with something, and that there isn't maybe a good reason other than history for why, you know, the ILC charter should exist. But to change that would be to kind of step on maybe the state regulators' toes, or to take away the autonomy that a bank has in electing to become, like a Fed member bank or something like that, right? And so it's just so interesting to me that, like, there are these turf wars that come out that relate back to the fact that, like, we have more than one type of bank charter in the United States. We have like 51 regulators you can get them from, depending on where you're based. And then we have another set of regulation if you want to have a holding company. And so, you know, I think we're always kind of like, we're never like designing the system the way we want it. We're kind of, you know, making tweaks to the system the way we have, like the way we built it, without actually being like, you know, is this a modern regulatory system? Or do we need more than one type of bank charter? Who should be allowed to get bank charters? Who should be allowed to own banks, right? We're always kind of being like, well, like 100 years ago, we let, you know, the widget company own a bank. And so we got to keep letting widget companies in some capacity own banks today, because we did it 100 years ago and we can't change that, you know? So I think ultimately, you should pick a lot of fights, collapse all the charters, simplify it, stop with the regulatory arbitrage, or don't, right? Like, or be like, you know, as many charters as humanly possible, but then like actually award ILCs then. Like, if you have the ILC charter, award ILC charters. right? Or are you just hoping that they all go away through attrition?
Yeah, I mean, it seems like it changes, right? Depending on like the time and who's in charge and everything. Because I mean, ILCs were impossible to get, and then they became possible for a short window. And Square got one,
Yeah, there
Nelnet
was a
one, and like,
literal moratorium for a bit. And then
yeah,
they became possible because one person who got to award ILCs got to be in charge. And then that person left. So now we don't have any ILCs. New
right, right. So
ILCs.
not a great system to your point, and obviously, like if we were to design our regulatory system from first principles, it would look a lot different than what we have. But I think the other point that you made that's kind of interesting about the bank holding companies is just like, to me, a very simple sort of standard from a bank holding company perspective should be like, should you be required to be regulated as a bank holding company? Well, are you a large corporation that makes a majority of its revenue from banking? Then yes, probably. And by the way,
Okay.
towards
Yeah.
the end, like General Electric probably should have been regulated as a bank holding company, because it was like, an electrical company only sort of by name, but it was actually more of a financial services conglomerate by the end
Honestly,
before
okay,
they
but here's
spun
the
all of
thing.
that off.
I don't want to litigate GE, but it should have been regulated as an insurer. And I think insurers have even crazier, right? I think it's all state-based. So
no, I think that's right.
Yeah, it was making a lot of money through insurance. And which,
right.
Is still different than banking.
Right,
yeah,
right. No, I agree.
Arguably, it was becoming
Yeah, so like there's probably a principle there that makes sense. But then I think kind of to your other point about just how many charters we have, and then we can wrap up on the story. Did you know, Kiah Haslett, that Fiserv, everyone's favorite banking core provider, recently applied for a merchant acquirer limited purpose bank charter in the state of Georgia? Did you know that?
Did you know this charter existed before you read this story?
No, I did not. Did you?
I didn't know it existed. Why am I learning about new charters from news stories?
It's a great question. Apparently, according to the article I read in American Banker, this would allow Fiserv to control the entire payment process, including authorization, settling, and clearing of debit and credit card transactions, which normally they have to use bank partners to help facilitate, right? So this is that whole sort of how close to the metal can you get without being a bank thing. This would allow Fiserv to get closer to the metal and to be able to do more of this stuff. And I don't know. I mean, I don't know a lot about what a merchant acquirer limited purpose bank charter is exactly. Although I would hazard a guess that Adyen maybe has one of these too. Someone can fact check me on that. But I believe Adyen does have a bank charter in the US, and it might be one of these special purpose charters. But like, broadly speaking, maybe the answer here is, to your earlier point, more special purpose charters that limit the scope of what the charter holder can do. So, from a safety and soundness perspective, like, we're not going to let you do the GE thing where you expand into every financial services vertical simultaneously in every country around the world. But at the same time, it does allow you to specialize in certain areas, lending, payment processing, whatever, and become more profitable based on the value that you provide to customers, which again, banks are going to object to because they don't want people taking profits out of the banking industry that they're not getting. But again, I don't care about that personally, right? So maybe there's like a middle road there.
I also read either in Banking Dive or American Banker that Fiserv is interested in this because I believe they are seeing that banks just don't want to do this very particular type of business. It's hard for banks to make money, I guess, from it.
Right.
But it's really important for Fiserv. And I was like, you were talking, I was like, why doesn't Fiserv get an ILC in addition to no charters being approved? They probably don't want to own have to take deposits. But it is interesting because, one, who's keeping the list of all the states that offer this? And, does this, I always wonder with these like state regulators, like, does, can Georgia go see, have the resources to go oversee a company like Fiserv? And what would that kind of look like to have the regulation? Although Fiserv may also be supervised as like a service provider. So
I think they are. I think they are.
That.
Yeah.
But and it is interesting too, because, what if banks protest this charter application, but then don't want to provide the service, right? Like, then we're kind of at this, it's just.
Well, yeah, no. And
all the charters are no
To
charters.
that point. Yeah, no, I mean, and it's hard, right? Because and this kind of gets into the other thing that we see a lot in fintech as well, which is like, are you competing with banks? Are you partnering with banks? Are you a vendor that sells services to banks? Are you all three simultaneously? And like Fiserv is a good example of one where is this kind of competitive to banks? Yeah, but they also don't really like to do this business, and it only works at a massive scale, which Fiserv has achieved.
Yeah.
And they also do sell services to banks. That's their main business, which would mean that like even if they could get approved for an ILC, maybe banks would flip out about them getting an ILC, but wouldn't about this special one in Georgia. Like, I don't know, but I do think there is a delicate dance to picking out like which charter can we pick that's going to enable us to do what we want to do, likely get approved, and not piss too many people off. Because it does feel like, to put a capper on this, the thing you don't want is the Walmart thing, which is you try to sort of just slip in a charter
you
and just
unite
like, hey,
an
like,
entire industry, all the big banks, the little banks.
They just freak out, and they all call their congressmen and senators, and then it becomes a big issue. So I do think there is an art to slipping in there and trying to get the charter that you need. Kiah, let's wrap up with a couple of just real quick stories before we get into some of the questions that we have. You go first.
Yeah. So let me tell you, we've kind of alluded to this, but I read a report that made my head explode. And if you are a frequent listener of this show, you can probably guess the news item. It is that the U.S. Transportation Department is scrutinizing the frequent flyer programs of U.S. airlines. U.S. airlines are not banks. And so I was very confused about some of the kind of regulation or violations that they might find, because it's kind of like bank, it's all weirdly bank adjacent in a way that I think is bad. And I think that, there are some really important distinctions when you kind of apply the principles of, bank regulation to things that aren't banks. And so the DOT is going to look at just...
Yeah, like the U.S. Transportation Department is not exactly a traditional financial services regulator. Keep going.
Okay, but so, I mean, even, the DOT is looking at potential deceptive or unfair practices. And
UDAP, they're looking at UDAP.
They're using UDAP on the frequent flyer programs. And I want them to make it so that I don't stay on the runway for 3 hours. And also when Southwest loses luggage for a week,
right,
that I'm compensated. That's those are the problems I want the DOT to solve.
Well, like the window blowing out of the new Boeing plane, that'd be a good one. I'd like... Fix that. Don't what are you doing with UDAP? This is so weird. Yeah. So they're scrutinizing it right now.
So they're looking at things like the transparency practices for booking award tickets, the transferability of miles, and the notice given before making changes. I bet everyone can guess what led to this investigation. It is probably the Delta, controversial devaluation and the outcry, which Delta undid to a certain extent. And so we are talking about something that didn't happen to a certain extent. And so apparently the DOT is concerned that airlines are changing point systems in a way that's unfair to consumers, including the devaluation. And I think that's so interesting because, again, these are kind of financial parallels. And famously, airlines are now, companies that sell frequent flyer miles to banks and then happen to fly planes on the side. That is where they make most of their money. So I guess you could say this is kind of a material practice from their perspective. But I also do just think that this is a total caveat emptor situation. Buyer got to beware. Prices can change. Prices are dynamic. They can change at any time. The airlines are supposed to make money from all of their programs. They're not really supposed to lose money on their point system. And so with the proliferation of websites that have told people how to maximize their redemptions, and airlines, maybe their computer systems aren't smart enough to keep up with how the redemptions work and how, if you're willing to figure out the partner transfers, whatever, if you're willing to do all that, the airline might lose some money and need to kind of correct it every, couple of years. And I just can't believe all U.S. regulator is getting involved in this oddly parallel financial topic when we have just talked about, the the problems that you should be solving and the problems that you are solving. So that's my update. Stay tuned. I'm going to be really upset if they mess with these programs.
That's amazing. Well, okay, so just one quick theory for you on this. You know how they talk about there being 4 pillars that the world rests on and that everything sort of can be reduced to these 4 pillars? Well, what the one that people talk about lately is interest rates, right? So interest rates are what the entire world and economy and everything you look around and see in the world as a result of interest rate policy. And there's like, 2 or 3 other like things that are sort of foundationally important to how everything in the world works. Is it possible that one of those things is airline reward systems and point systems? Because it's weird, right? Because like here we are all living our lives and everything's going fine. And then Delta makes what to me, a not very frequent flyer, seems like a somewhat innocuous change I could see people being annoyed about. People flip out. They like flip out in a way that is really odd. You know what I mean?
Also, Delta didn't even really change. Okay, they didn't really change. Sorry to get so specific about this. They didn't really change the redemption values. They changed how much you'd have to spend or fly to become like the level of frequent flyer. Like, again, like the thing is just not the thing. And like, this is just not a problem that I think, I don't think anyone can say it's unfair. I don't think anyone can say it's like unclear. To me, it's more like, I think what people don't like experiencing is inflation. And outside of, 21 and 22, most people would experience inflation when their points got worth less because the awards cost more. Like that was probably my experience with inflation before this, but it just kind of stuff, it just kind of is like, if you don't like it, don't play the game, don't collect the points, don't have the credit card. No one is forcing you to have this credit card. No one's forcing you to fly on any specific airline and accumulate its points and then try to redeem it. So that's why I just don't understand, this application. And it is, we talk sometimes about how regulators are like getting into everything. And this is like one of those where I'm like, this is not a problem. Like the problem got solved, right? Like, consumers rebelled. Every other airline took advantage of Delta.
Changes they were going to make. Yeah.
Right.
Well, and I think my core theory on why this is coming up, because you saw like Dick Durbin mention this. You remember that a little while ago where he was like complaining about points and stuff. I do really honestly think that why this is happening and probably will keep happening is some congressperson or senator, and maybe it was Dick Durbin, maybe it was someone else, maybe it's a set of them, they got personally pissed about it, right? Because you have to think like people in Congress fly a lot. They probably are like very like sort of power users of these different reward programs, and so is their staff. It has to be like someone in Congress is just pissed about this and they're ignoring all of their other responsibilities to just heap pressure behind the scenes on like any regulatory agency they can find to be like, make this your number one priority. But it's like, to your point, what the hell is the Department of Transportation doing looking at UDAP for rewards points? That's like the craziest headline ever.
Yeah, and it's so close to banking that like maybe banks feel a little comforted that it's not just them. It's happening in other industries.
That's true. Yeah. I mean, I would think it's like that meme with I don't even know what show it is, but the guy with the noose around his neck and he's looking at the guy next to him is like, your first time, huh? Like banks are probably just being like, your first time dealing with UDAP. That's a tough one. All right, Kiah, speaking of Dick Durbin, can I give you one super quick news story or update that I want to rant about for a sec?
The transitions today are like banging. They are seamless.
I know.
Go on.
I know, we're on fire. I did get like a almost full night's sleep last night, so I've got more mental capacity than I normally do on this podcast. Okay, so mine is the ongoing debate around Durbin 2.0, which is Dick Durbin's attempt to sort of replicate versions of what he's done on the debit card side of the house on the credit card side of the house.
Right.
Nothing has actually happened on this, but it also is a effort that continues on. And, I guess it only takes one good crisis to slip these things through, as we found out with 2010 and Dodd-Frank. So as part of the ongoing sort of legislative process around this, the Congressional Research Service basically put out sort of an analysis of Durbin 2.0 and the different sort of proposed changes and the impact that it might have. And this is a fairly standard sort of part of the process that proposed legislation goes through to sort of understand the impacts it will have so people can vote intelligently on it, I suppose. Well, basically, in their conclusions, when they were sort of writing about this proposal, they said, quote, the ultimate impact of routing restriction prohibitions, which is one of the parts of it, is not certain, and that if it is impactful, it's unclear who would benefit. And specifically, Kiah, if you go down a couple more sentences, you will find a line that caused me to black out briefly, which was, in addition, it is not clear whether retailers would pass interchange savings on to consumers.
How did that make you feel when you read that?
Whether retailers, oh God, The one thing we know, the one thing I feel like we should know based on our own experiences in the US as well as many other experiences around the world is we know for sure it is 100% abundantly clear that retailers will not pass on interchange savings to consumers. And seeing that published by the Congressional Research Service, I feel like I'm going crazy, Kiah. Like, what are we doing here? I mean, like, if we want to transfer more money to large retailers, who, by the way, are the ones that are most able to operationalize these new routing requirements and things, that's not something that your small little local coffee shop down the street is going to do. It's something that Target and Walmart and Amazon are going to do. If we want to subsidize that and put more money in their pockets, that's fine, but let's just call it what it is. Like, I've never seen a public policy thing where we know the answer so clearly, and yet it keeps coming up and they're like, well, I don't know. Who knows? It's impossible to predict. Like, no, it's not. It's A, super logical to try to predict what's going to happen, and B, we have evidence of it happening before. What are we doing?
I mean, I feel like you should just write and do like letter to the editor to the Congressional Research Service and be like, hey, I saw an error in your report when you said here it's not clear whether retailers, I think you meant it is like crystal clear that retailers will not pass interchange. And that, like, it's funny because like when you're a journalist, sometimes you gotta like hedge because you're just like, this is like mostly true, or it could be true, or it could
likely
not be.
this
It won't
is
be
going
true
to happen.
for all.
Yeah,
it won't be true for everyone.
Mm-hmm.
But you kind of have to say stuff. And then I feel like someone was just doing the hedge of just like, I can't say definitively that it's not true. And I can't point to something. And so because I can't point to something directly, I have to say this terrible thing, which is that it's not clear whether. And it's like, yeah, but I mean, you could even say like the past experience hasn't, you know, even though it's available, it's within the realm of possibility. That is often not what is the option that the retailers select.
Totally.
Yeah. I think Durbin, you know, what's so crazy is like in 2018, I really felt banks should have like shot their shot on Durbin and tried to get it undone when the big tax cut went through, because they got like the SIFI threshold raised, right? They got it raised from $50 billion to $250 billion, which is how SVB managed to just duck under the radar of all the heightened regulation. So they get that raised and they couldn't get Durbin undone. Like, oh man, what a missed opportunity.
I know. Well, they could have framed it.
You'll never kind of get that again.
You'll never have that window open again. No, it's 100% true. Yeah. And I feel like, you know, as much as you're like, oh, you know, retailers will pass savings on to consumers, you know, like, no, that's not going to happen. It's possible. Well, I mean, like, you know, we could also say, like, if we repealed Durbin, it's possible that debit card rewards would come back. You know, like, that's possible. That's possible. Now, do I think that's likely? No. Or if it does, it's going to happen at a level that's a lot less than what we used to have. Like, companies don't voluntarily give money away when they don't have to. But like, if we're going to go into the realm of what's possible, all kinds of things are possible. Yeah, it's funny you mentioned the journalistic hedging thing, because that's where my brain immediately went to. I saw this and I was like, just say the thing, man. Just say the thing. Just say the thing. Like, we all know it's true. Like, there's no need to get cute about this. All right. So we want to wrap up, as we always do, with a couple of questions. The first one is wait, but why is this the way that this is question? So Kiah, I think you have one of these for me today.
Yeah. So Alex, why is it that central banks have so many different and arguably conflicting jobs or roles and responsibilities?
Oh, Kiah, I'm so glad you asked me this question. So
I know that you're a big fan of central banks. So
I love central banks. You know how I do. So you had sent me an article, a paper a while ago that was entitled Structural Conflicts in Central Banking, Regulator or Operator of a Payment System, which was by Aaron Klein at the Brookings Institute. And it was just such a well-written title, honestly, because it hit at something that I've been, you know, really kind of bothered by for a while, which is, you know, in my non-fintech circles, when people ask me like questions about different things in financial services, one of the questions I sometimes get, particularly when interest rates were going up really quickly, was like, what does the Fed do? And I like had to like grab the person and sit them down and be like, all right, I need like a good 25 minutes here. You got to just like pay attention, give me 25 solid minutes, because they actually do a whole bunch of different things. They regulate bank holding companies, as we've been talking about. They manage monetary policy, which is what you have been seeing happen and what everyone's been talking about. And they also operate a payment system. And if you'd like to learn more, listen to my podcast where we interviewed the head of the Federal Reserve payment system. So, like, they have all of these different roles. And I do think it is a really weird sort of collection of different jobs that sometimes maybe do sort of intersect with each other in ways that aren't great. And, you know, I mean, I always like to sort of imagine the alternate universe where, like, you know, imagine if the Fed ran its payments infrastructure like the mob, where they're like, hey, nice private market payments network you have there, clearinghouse. Be a shame if anything happened to it, right? Like, you know, I mean, we sort of rely in some ways more on like norms around the way that these different central banks operate and sort of our expectations around what they're going to do, right?
That's like why the Fed is a payment operator, right? Because of the norms that was set up with like, you know, interstate banking and before like electronic payments was the Fed needed to kind of clear payments of banks in its regions, right? It's like totally norm-based.
Yeah, no. And so it's just like we have, it kind of goes back to what you were saying before about we have the system more because of history than like it makes sense. But yeah, like these various roles of the central bank, and you see this in other countries too, it is just very, very strange. And I think it does create these conflicts. And we've talked about this on the show before too, right? Like you have these sort of new-ish state-level banks that convince, you know, like a crypto company in Wyoming gets a new special crypto bank charter, right? Which is totally bizarre. But then they go to the Federal Reserve and they're like, well, you know, I'm a bank. I'd like to get access to, you know, the Federal Reserve payment system. And the Federal Reserve is like, yeah. And it's like, are they, why are they restricting access to that? And how much does that have to do with the interests of the bank holding companies that they also happen to regulate over here? And I mean, I don't know if I buy into all of the conspiracy theories about, I mean, I certainly don't buy into the really wacky ones about the central bank, but even like the more mild, like conflict of interest-y type ones, I don't know how much truth there is actually to that, but they open themselves up to all of these discussions by having all these same jobs under one roof. It's weird.
Well, you know, I think Aaron, I can't remember when he wrote that paper, but the Fed also was one of the primary regulators of several of the banks that failed. And so he was talking about, you know, whether it's appropriate that the Fed, which has so many important jobs, like, you know, the Fed's like too big to be failing, right? Interest rate policy. And they write a bunch of rules, and they're an examiner, and they're a regulator of the payment system, and they're an operator of the payment system. And that the Fed has this supervision role and like oversees really big banks. And some of those banks failed this year. And that's just something that's really interesting too, is that I don't think like there's, you know, people wearing too many hats at the Fed, but it's almost like it has too many mandates and it's trying to be all of the things. And I think that that can be really confusing. And also, I think it's, you know, we've talked a little about the master accounts, right? The Fed runs this system, runs the payment system that you need the master account for. But also, they get to decide who gets a master account. And then it's not like a clear process. The list that they put out leaves a lot to be desired because the number one way to get a master account is to be a bank.
Yeah.
And then it's like, okay, but are there any not banks? And they're like, maybe. Like,
a couple, maybe, yeah.
Yeah. But, and there are non-banks. And so why did those get master accounts and under what rationale? And so it is really interesting because it's like, kind of like, I don't know, it's kind of like the Supreme Court, right? Like no one can check the Fed. The Fed's kind of the final say on a lot of stuff, including, you know, monetary policy, including regulation, including the master accounts and the payment system. And so,
like, to your point, I mean, there's a nice thing about division of labor within the regulatory sort of apparatus, right? Because I'll give you an example of what I'm talking about. I've been spending a lot of time on like things that the CFPB is working on right now, right? So like open banking as an example. And like open banking, I just read all the comment letters that were submitted on the proposed rule for 1033. Yeah, I read every one of the 11,000, Kiah. Nice. Don't question me on that. I promise I did. Like, don't poke at that claim at all. And no, in the ones that I actually did read, one of the things that came up, particularly from like the bank perspective, was the banks referenced their prudential regulators a lot, right? And they were like, hey, if we had this rule the way it's written right now, this would bring us into conflict with things that the FDIC or the OCC or the Fed want us to do or require us to do. We would like you guys to like work this out. And I get that that's annoying, right, to banks to have like two different sets of regulators, one that's focused on consumer protection, one that's focused on prudential matters. And like sometimes their rules or their guidance comes into conflict. But at the same time, I also think it's really healthy for our regulatory system to have those conflicting objectives that have to kind of get worked out over time. I mean, imagine the alternate where all consumer protection regulation falls underneath the same prudential regulators, right?
I think that might be how it is in other countries, though, right?
I think it probably is. No, I think it is. But like, I would worry about like that from a consumer protection perspective, because I think that would make it so much easier for, using open banking as an example, for banks to go, let's just say like the OCC was in charge of open banking and all sort of consumer protection. It fell under the OCC. I don't know that I want the OCC having to weigh by itself the argument for its prudential regulations and the requirements it has around those, like third-party risk management, and the consumer benefits of open banking. Because when the banks go, hey, we'd love to do this, but it would make us a lot more, difficult to manage third-party risk and might put the financial system at jeopardy, like that would be an argument that would be much more persuasive to the OCC under that sort of hypothetical than it is to the CFPB, who's like, look, I get it, and we'll try to sort of work with the OCC and we'll try to like make these regulatory requirements harmonize with each other. But at the end of the day, we're not going to let you sort of get away with just saying this is bad because of this other thing. So I don't know. I think there is a benefit to jobs being separated by different agencies and a little bit of interagency conflict. And the Fed is the example of when you don't have that. Like they just do a bunch of different stuff and you're never quite sure why they're doing what they're doing. And, even we talked about on one of our previous podcasts last year, we talked about the change to the way that the Durbin Amendment is being applied to interchange caps, right? And like what that might get adjusted to. And it's like, okay, so the Fed is doing this thing, which again does not make any sense and is probably more the function of like legal things that are happening behind the scenes. But like, again, if I put on my conspiracy hat, like, what does the Fed making debit cards even less profitable potentially incentivize? Does it incentivize banks to adopt Fed Now faster? Like, I don't think that is a real thing. That's not a conspiracy theory I'm throwing out there. I don't believe that. But like, you can start to draw lines between things in a way that isn't probably real and that you shouldn't be able to, but you can because it's all under one big roof. So I don't know. It's weird.
I haven't mentioned this because I keep trying to just cut myself off, but several times in the outline today, because I think we have thematic items, I have mentioned that this feels like a premise related to the book Fragile by Design, which is going to be in your Fintech book club. And that looks at how the different countries have set up their banking systems and their regulatory systems to prioritize different things at the time. And often these are not based in financial safety and soundness. They are based on geographic concerns. They are based on population concerns. They're based on like who should get to control the money in a country. And, sometimes they're based on, does our country have like a lot of natural resources? And so I think about that like, whether they compare and contrast the United States and Canada's banking landscape. Canada has never had a banking crisis, not during the financial crisis, not during the Great Recession, and they are dominated by very large banks. And as we learned, Canadians love their banks. I found this in my anecdotal research, and you pissed everyone off on Twitter. So
I did.
And that's really different than the United States, even though there aren't really like big, it doesn't feel like there are really big distinctions between an American person and a Canadian person. And so sometimes I like to think that like the things are the way they are because like there is a value that Congress, there is a value that the regulators are enacting that is not related ostensibly to whatever their public mandate is. And I think in this situation,
they're like value
the Fed,
judgments, really.
The Fed has a lot of different like policy mandates that it has been given about the kind of world that it should help create. And so then they have to do things that are really confusing sometimes, like be the operator of the payment system that they regulate. And the regulator of that payment system did not force the operator to upgrade the payment system for years. And everyone,
Right.
and then the regulator told the operator of the payment system that not everyone can get a master account. And the operator was like, okay, that's fine. And then the policymaker raised interest rates by 5%. And then it created problems for the examiners in that same building, right? Like these are just a bunch of different policies that are being enacted and that then everyone kind of has to deal with, and then banks have to deal with. So I kind of keep coming back to like that they are not really about, these are just different values that, Congress and regulators have said that they wanted. And so then they have to enact them no matter how much they conflict with each other.
Yeah, I completely agree with that. I mean, it sets us up for a very, very strange world. And I think your point about, regulators and why they decide to do things the way that they do is there is that value judgment component to it, right? I mean, part of it is your mandate, part of it is what you're required to do. There are restrictions, right? Like, they're not allowed to charge for this. They are required to recoup their costs so that taxpayers don't bear the cost of this. Like, there are statutory requirements, but within all of that gray zone, they're just decisions that get made on like what kind of world we want to create.
Yeah.
And that can feel just incredibly, I mean, it's on the one hand, it's very culturally specific. And I think that, if you studied the history and that Fragile by Design book, by the way, I've started reading it, is amazing because it does trace the history. I have. It's dry. It's not like John Grisham or anything, but it really is pretty interesting because it goes into the history of sort of regulatory design of banking systems in different countries and kind of compares and contrasts them. And it is so fascinating because it's just like there are these choices that get made about we're going to prioritize X because that's what we do here.
They have nothing to do with financial like safety and soundness, right?
No,
and profitability.
No.
They are just completely divorced from that.
Yeah, or it's like, or both, path A and path B they could go down are both pretty equal in terms of like what the impact on general safety and soundness would be.
Sure.
But they pick A because in America we do this, or they pick B because in Canada we do this. And then what happens is, and this is, I think, the thing that's really interesting, it all kind of becomes precedent that builds on each other, like you were saying earlier. And so instead of re-examining old assumptions, like, for example, I would love to re-examine the assumption of the Federal Reserve shouldn't play a direct role in interacting with consumers. Like, I personally think there should be like a FedNow wallet or something.
Yeah, public bank.
Teasing our next topic a little bit. Yeah, like I'd be kind of cool with that as like a competitor to banks and fintech companies. But we made the decision 150 years ago or whatever it was that we're not going to do that. And every update we make to the system is building on that choice that some white dude a long time ago made. So it is really weird how that happens. And I mentioned digital wallets. Kiah, I have a question for you that I'd like to segue to, if that's okay.
Yes.
Okay. This is my question under the category of possibly unanswerable, because I don't know that there is a good answer, but I think it's worth poking at. Kiah, should banks offer digital wallets?
Alex, I don't know, but I think they want to offer digital wallets. But I think they want, this is my outside consumer who kind of doesn't really understand any of these moves, but let's talk about them. I think they want to offer digital wallets because other companies offer digital wallets. And so this is a thing that they're doing because someone else did it first. And then they realized like they were a natural option to offer the wallet and are trying to get back into this. But frankly, I don't understand. Like, to me, this seems completely solved and addressed. And it is so interesting to me that digital wallets is this new battleground for both regulators and tech companies and big banks. And I don't think consumers like me care about digital wallets. So every time I read a digital wallet thing, I'm a little confused because it has not been answered in that like article or whatever of like, how does this help consumers? And how is this not just going to be one more app or one more thing or one more place their information is stored? So why should banks offer digital wallets?
Well, so I think the question you asked a little bit ago is the exact right one, which is like, isn't this already a solved problem? And what it exactly reminds me of is it reminds me of P2P payments a lot, right?
Yeah.
Which is to say, there's this thing, right? There's this analog thing that exists. So in the case of P2P payments, it was cash, right? Like, hey, Kiah, we went out to lunch. You owe me, $15 and you give me $15 out of your wallet. Done deal. And then banks sort of just assumed that the way that consumers were doing this activity, this P2P payments activity, would continue on the way that it always has been forever, and missed an underlying shift in technology that opened up an opportunity to create a different version of that product, which is P2P payments apps. So then a whole bunch of non-bank companies come in and go, ooh, this would be cool. Like, what if you didn't have to give Kiah cash? What if I could just Venmo her the balance for lunch? And a whole ecosystem is born out of that. And what banks then realize, seeing that, is they go, well, we should have been the ones to do that.
Right.
And again, this kind of is like my whole, like, what's good for a bank is not always good for a consumer thing. Like, yeah, I get that you're upset by that, but then banks were like, well, we have to get into P2P. And I can tell you this from firsthand experience, talking to a lot of bank executives about P2P over the years. The level to which they were haunted by Venmo for years was startling. Like, you'd ask a bank about fintech stuff, you'd ask a bank executive or CEO, and the first thing they would say would be like, well, my kids, or in a lot of cases, my grandkids, they use Venmo, so we have to do that.
Yeah, it really bothered them.
Yeah, like it was the one thing that broke into their consciousness was like, we have to do something about Venmo. And you're like, you'd ask them questions like, well, are you really losing any like payments volume because of Venmo? Or like, is this meaningfully changing like the nature of the relationships you have with your customers? Or like, what's like the business case for wanting to compete with Venmo? They're like, we just have to do it. And you're like, okay. And so then EWS comes out with Zelle and, makes an acquisition, launches Zelle. And again, I can tell you from firsthand experience, the sales process for Zelle was like not based on business logic at all. It was really like, you will sign up for Zelle. And you're like, well, okay, do we need it? They're like, oh, you need it. And it's like, is it going to be expensive or is it cheap? They're like, oh, it's going to be really expensive. And you're like, okay, can I charge my customers money for it? They're like, no, you can't charge your customers any money for it. And you're like, okay, is the money going to move on like kind of traditional ACH rails? They're like, no, the money's going to move in real time. And you're like, okay, but won't that create a big fraud problem? They're like, oh, the fraud problem is massive. And you're like, okay, well, I guess we got to do it. And it's like, the whole conversation made no sense. And yet everybody was just like, well, we have to do it. We have to get on board with it.
Right.
And so Zelle becomes this like thing, not because it made sense or because it necessarily filled a huge gap for consumers. Now, I will say the real-time thing, Zelle has kind of carved out a lane for itself over time, kind of by brute force, particularly around larger transactions. So people pay their rent or things that are more time-sensitive with Zelle. So, I mean, Zelle just by nature of like the network effect that banks had, it kind of forced its way in to the party. But it wasn't like people were looking around going like, this is a massively unsolved problem. Like, that's not what was happening. And so to your point, I think digital wallets are exactly the same, where banks were like, okay, so the analog solution here is people just have actual like leather wallets that they keep with them. And that has a lot of their payment instruments in it. It has identity cards. It has rewards. It has a bunch of different things. Like, cool, wallets are solved. Like, we don't need to worry about that. And then companies like PayPal and Apple and Google, all appear. I guess Twitter is maybe getting into payments. Like, these companies appear and they're like, well, what if there was a digital wallet? And you're like, okay. And, they present a vision of what a digital wallet can look like. And it's convenient in some ways, right? I don't know if you're a big user of like Apple Pay or anything, but there are parts about it that are nice and kind of convenient. And they can even now like digitize a driver's license in certain states and put it in there. And I feel like we're playing this whole P2P thing out again, where banks are looking at this and going like, well, shit, we should have been the ones to do a digital wallet. Like, why did they get to do a digital wallet? We should do a digital wallet. And they're, again, ignoring the question of, well, is anyone asking for another digital wallet? Like, are we kind of set on digital wallets? And they're like, no. You need to have a digital wallet. And guess what's coming next? From our friends at EWS, Pays. And so, like, again, we're playing this same pattern out again. And I'm not, disparaging Pays. I don't know too much about it. Maybe it's going to be amazing, but it does very much feel like banks sort of shouldering their way into an already well-solved problem area.
It's funny. I use Apple Pay when I'm buying stuff on my phone, which I don't know how Pays would work to replace that particular transaction. And I do use Amazon, or I do PayPal for stuff online sometimes. And I don't really, I don't even understand. And I understand, I use PayPal and then I have a bunch of my cards in PayPal. So that technically constitutes a digital wallet. And then PayPal somehow debits or charges my card, but then sends the money. And so I get credit for the purchase. And that and I feel like all my needs are met from this transaction. And I also have many credit cards. And so I don't know how pays would work having products from different financial institutions. And that's what I kind of like about PayPal and Apple, is that they're not just my one bank that I have most of my cards with. And I like Zelle. I think Zelle should have existed before Venmo. But again, the thing about P2P and the thing about digital wallets is that sometimes I think banks don't really care about what your problems are. They give you products, but they don't help you do the thing with the product. And so these tech companies have created the technology that makes that product, the card, the bank account, more useful to me and more applicable in all these different situations. And so now I've changed my financial habits, but I don't really know why I would need another one of those, and why one that comes from a bank is going to be so much better than one that doesn't come from a bank. The other thing too is I know that, the CFPB is very interested in this. And I also don't really know kind of what the CFPB is concerned about with the big tech companies, because I guess I'm not concerned about the big tech companies having this digital wallet. And so I don't know what the CFPB is concerned about.
Yeah, I mean, I agree with you, right? I mean, I think that, I guess the concern, if I was to sort of play this out, would be back in the day prior to 2014, 2015, I want to say, the early days of PayPal, they would do payment steering, right? Which was, hey, you're going to check out, you have a credit card loaded into PayPal, you should load your bank account information into PayPal. And if you pay directly by debiting your bank account, that's better. You should do that instead of cards. And so there was always this tension between PayPal and Visa and MasterCard, which in that instance were representing the interests of issuers on their network, basically saying the problem with digital wallets is at any time they can decide to steer the consumer because they're at the front of the experience. They've solved that last mile problem, to your point. That has given them the right to steer consumer behavior in a way that might be bad economically for the interests of banks, or I guess from a regulatory perspective, would allow them to exercise undue influence or sort of monopolistic control over that interaction. And I'm using that framing specifically because when it comes from the CFPB, big tech is just one giant sort of antitrust puzzle for Rohit Chopra to solve. Right. And so I think that the concerns are antitrust, the concerns are being able to steer people away from things. But, I mean, again, kind of goes to your point about banks ignoring this problem. You have evinced no interest over time in thinking holistically about what's the best thing to build for me as a consumer, A, and B, kind of going to your point about pays. And again, I don't know exactly how it's going to work. Maybe the user experience is going to be amazing. But what I can tell you is the Apple Pay experience is actually amazing, right? Because I use it the same way you do, which is e-commerce transactions on my phone.
Arguably.
It's stupid. Yeah, it's stupid easy because it's you go and you push, do you want to pay with Apple Pay? You push the button on there. You just use the biometrics to log in. By the way, using the biometrics, zero of my personal information is transmitted anywhere. It all just stays on the phone, which is encrypted. And not only does it fill in my payments information, and I can use my Capital One card and still get rewards, so that doesn't change anything. And it also fills in all of my shipping information. So it's literally amazing, and it works perfectly. And whether it's that or it's the Amazon buy button, which is getting integrated into non-Amazon websites, or it's PayPal or it's whatever, they have earned the right to play that role in my life as a consumer. And in the case of Apple, they had to sell me this handset, this little supercomputer in my pocket, to earn the right to be able to do this other thing. And so in a sense, is it monopolistic? Yeah. But they also, from my perspective, I'm very happy with them doing it. For the most part, I'm pretty happy living in an Apple ecosystem as long as they don't abuse the privilege there. Now, if they came along and said, hey, we know you love using Apple Pay, we know it's super convenient, you can't load non-Apple credit cards into Apple Pay anymore. You have to just use the Apple credit card.
Stop using it tomorrow. Stop. It
right,
would be fine.
Exactly.
Arguably better for my wallet.
And to the no, I mean, it really would be, right? No, exactly. So to me, there are lines that they might cross. Going back to your Delta thing, you could push it too far and then people will freak out, or regulators will get involved from a UDAP perspective, apparently. But until big tech crosses that line and tries to abuse the position that it has, it earned its position.
Yeah.
And I don't know that I'm super concerned about like, wow, they need a lot more competition there. So I don't know, maybe that's not the answer that the CFPB would give, but like, as I think about it as a consumer, I kind of keep coming back to that.
I will say that again, because I'm like a credit card chaos monkey, I actually changed my payments a lot. Like, I keep a spreadsheet of what card my insurance is billed on, what card my gym is billed on, what card Blue Apron.
This is such a YNAB sort of way of thinking. I love it.
But if Pays wants to solve my very specific problem that sometimes I need to switch my cards to hit different spending challenges, and I'll be that beta tester. I will boldly I'll boldly do it, because it's not so much time that I'm not going to do it, but it happens with a frequency by which I am ashamed to sometimes admit the amount of like tracking of what charges on what card, and that sometimes like one card has to take all the charges. Sometimes one card is going to be for gyms this month, or for the quarter, right? So, if you have those quarterly cards. And so there is like kind of an application. My big blue bank could do this for me. Could be like, hey, Kiah, we saw that you activated your quarterly categories. Do you want us to change? We noticed out of all the transactions, you have a gym membership. Do you want us to go ahead and change that to help you get that? Do you want us to change like your Lyft and Uber now that you have a card that gets X amount of points? Now, obviously, the bank doesn't want me to earn as many points as humanly possible. So that's why the bank doesn't do it. And that's why I do it. But that is a use that that's a specific digital wallet could serve for me. And I would change my behavior so fast. So that's my one use case. I doubt it's going to materialize. And that would make it really different from Apple Pay in the way that like Apple Pay is like a very special experience, and is like does it all for you, and it is so fast and easy. And so I don't think banks can like replicate that experience, but go ahead and take my suggestion. It's free and I'll be your beta tester.
I love it. All right. Well, folks at EWS or any of the big banks that are listening who are thinking about wallet strategies, Kiah just gave you a great idea. I love that, actually. So we'll leave that one there. Before we wrap up, Kiah, just in the last couple of minutes, as always, we like to give you an opportunity to just blow off a little steam. So what's bugging you today?
Okay, I'm going to try to be quick, but if any of my past experiences have showed you, I will not be quick about this, because I'm actually really, this makes me so mad. So my rant today is, what are examiners looking at when they do an exam? What are they actually looking for? What is a yellow flag and what's a red flag? And I ask this not because I think because I think they do a really, really important job. And I think that they have had some, we don't write articles about all the planes that don't have the door plug fallout. We only write articles about the plane that has the door plug fallout. So when these failures in examination and supervision happen, they're really bad. And they also seem weirdly preventable or obvious in retrospect. And I say that because there was a story that came out last year that the nation's largest credit union, Navy Federal, rejected more than half of its Black conventional mortgage applicants. Navy Fed lends to military service members and veterans. They approved more than 75% of white borrowers who applied for a conventional home mortgage purchase in 2022. And then but less than 50% of Black borrowers who applied for the same type of loan were approved. Was it possible that this story got written? Well, it was using public data that comes from the CFPB. This did not come from a consent order or a CRA rating or downgrade or whatever. It came because a journalist downloaded a data set and ran some numbers. And this is not the first time this type of story has been written, because there's a decent amount of data based on who gets mortgages. And so, like I've seen headlines about Wells Fargo rejecting half of its Black applicants in mortgage refinancing. I think there was Revealed News did a story about redlining, and they were looking at banks that, based on their approvals and the race of those approvals, and these are using public data. And so, my question is, like, are examiners running the same analysis that journalists are running with this data? Does it get used in examinations? And that, like, someone at the regulator an analyst is doing the data and is like, hey, it's interesting that there's no matter what policy and process they're following, it's generating this result. And is this result something that an examiner could probably ask about and then say, that's so interesting, your models are producing this result? And what if anything, do regulators do with the HMDA data or the CFPB data set that reporters are using? And this, obviously has an applicability to the banking crisis in the spring. When I was reading the material loss, so one of the things about the banking crisis in the spring is it was like, you could see it coming. And all you had to do was hope that like there was nothing bad that was going to happen to set off a liquidity run, which is the first thing we talked about today. But I noticed in the FDIC's material loss review on First Republic, and First Republic was like, by all accounts, a pretty good bank, kind of the victim of its circumstances, totally 100% a deposit run. And I noticed this line that said, with respect to the examination team's focus, there is a risk that the dedicated examination team can become so focused on completing the continuous examination process steps, such as supervisory plans, quarterly ongoing monitoring, and target reviews, that they may not sufficiently observe how the risk landscape has changed. For example, some FDIC officials suggested that perhaps the dedicated team was too focused on First Republic's models and model validation efforts and did not provide sufficient attention to the bank's practices and actual interest rate risk positions. And so I'm so fascinated / confused about how examiners are kind of spending their time and what they're actually concerned about versus what they really should have been concerned about. Because what are you looking at in an exam, if not the actual interest rate position, rather than maybe like the model that is producing this result? How are we missing the actual results of like any bet or any decision, any credit decision? And we're kind of missing the totality of those results versus the like math that we used to get there and then the process by which we checked our math, right? And I'm a soccer referee, and I have sometimes said that soccer referees are like bank examiners in part because like our main concern is safety. The safety of the game, players, and then also like we have to enforce rules we didn't write, and we are the embodiment of the rules. And it's also really hard to do this. It's not really for everyone. You have to kind of manage a lot of personalities. But one thing I think about a lot when I referee soccer, I have to do like a series of tasks, including like I have to check that all the players who are going to enter the game today are on the roster, right? Like, because you can have unrostered players and then the insurance doesn't work, whatever. I have to like make sure they're properly equipped. I have to make sure the field has corner flags and that the goals are anchored. These are some kind of low-level process-based tasks. But my actual job is that I need to work really, really hard to get into position so that when I can anticipate a foul happening, and I have to have a look at that contact before the contact occurs. Because when the contact occurs, I have to be able to ascertain and evaluate the severity of the contact based on where did it happen, where is the ball, is it the front leg, is it the trail leg? And so then I can determine both if there's a foul and a misconduct and who committed it. I have to be aware that everyone on the field is also looking at the same thing and will have an opinion about whether I have seen it and correctly ascertained it or not. And I have to be aware that there's like a public nature to my action. So I can't be looking in those moments to say whether someone has an earring or whether someone's shirt is tucked in, which is technically part of my job. In those moments, I really, really have to look at the outcome of the actions and the direct steps that led to that outcome. And that's like, if I'm not doing that, then the game's not safe. If I'm not in position and making the big calls, especially to say like, this was an unsafe way to play, this is a yellow card, like the game's less safe. Even if I can say, yeah, that was everything except, the studs being up on the slide tackle was legal, right? Like, but I have to be able to say, the studs being up on the slide tackle made the tackle like a yellow card. And I think to myself that like, you don't get safe games by not calling fouls, right? Like the safe game you enforce the safety of the match by like being able to, manage contact and the outcomes of that contact in a way that reinforces the safety. And so I'm looking at this and I'm just thinking, how is examination conducted that we're focused more on process, but the process by which something happens, and we seem less focused on the outcomes of those processes. And also that I'm sorry, sometimes the math can look good and the outcome could also be a good outcome in 2021 and in 2022, but is a less acceptable outcome in 2023. So I just get so confused and worked up when I read these stories because I don't even know how they happen, that a journalist could write this story and a regulator would be like, thumbs up, looks good. You know what I mean? So I don't know. Totally. I don't know if that's something that you've been thinking about or like what you think when you read these stories, that it's just, these are just things that happen in the world and like nothing to be done,
Well, I mean, I think the point you made is a really good one, right? Which is like process versus outcomes seems to be sort of at the core of this, right? And I don't know if you've ever had a job at a company where one of the value propositions or one of the like company values is act like an owner, right? That's a very popular like mission statement-y like employee goal that we have is everyone who works here, we want them to act like an owner, which means that in doing their day-to-day jobs, we don't want them to just check the box. We don't want them to just do what they're asked. We want them to think about the overall company, what's best for the company, and always have that lens in everything that they're doing, such that when they're on the ground and they're seeing something that doesn't make sense, they're seeing that in the broader context of the business. And even if doing this thing might constitute doing their job in a narrow sense, they might not, or they might question it, or they might bring it to the attention of someone else because they're trying to act like an owner overall. That's like a value that I think exists a lot increasingly in people's jobs. And, I think I mentioned before on the podcast, I briefly had a career as a basketball referee, not nearly to the great accomplishment that you've achieved in soccer. I couldn't hack it. But one of the things I briefly observed was that there was kind of a similar thing in refereeing where there's a distinction between calling everything and calling a good game. Right. Yeah. And so like to give you like one example in basketball, one of the things you're not supposed to do is if there's like a foul on one end of the floor and then the team gets a fast break and is going the other way, and the coach of the team that thought there was a foul that maybe didn't get called starts screaming and yelling or, tells you to go do something that they shouldn't tell you to go do, you can give them you should give them a technical foul, but you shouldn't blow your whistle until after the play on the other end is over, because if you do that, you are disadvantaging the team that got a fast break going the other way. Yeah. And so it's not so much about the calls being right or wrong. Maybe you missed a foul call on the other end, but the overall intent is preserve the flow of the game and make sure your responsibility as a referee ultimately is a safe game with good flow that allows for kind of the spirit of whatever you're trying to accomplish to kind of manifest itself. Yeah. And sometimes that means calling everything really tightly. Sometimes it means calling everything tightly in the first quarter and then sort of loosening up to let people get more competitive over the course of a game, whatever it is. But like there's a feel thing associated with your ultimate responsibility, which is call a good game, not, hey, you have to get every one of your calls 100% right. And I feel like, that's that like outcome versus process thing. And so when I read things like the First Republic report that you were quoting, where they were talking about the team getting too focused on the steps and not looking at the bigger risk picture, it's like, if you're an examiner for First Republic, your job is to evaluate the risks facing First Republic holistically. So your job is to see the whole forest. And while there are steps and processes and scorecards and things you have to do on a micro level to do that, and those are important, those can't get in the way of you looking at the whole picture and going, they're telling me everything is good. They're telling me that their models are, within the range that they're supposed to be, blah, blah, blah. But these are concerns like if I was the CEO of First Republic, this is how I would want an examiner thinking. If I was the CEO of this bank, these are things I would be concerned about. And I want to make sure we address those concerns, even if some of those fall a little outside of the steps we're supposed to be looking at.
Yeah. Also, and I'm so sorry, I really should have said that everything I've said today is my opinion and not the opinion of my employer or anyone else. This extra applies to the rant. But I do think that there is, in refereeing, we talk about managing the game. and managing points of the game. Obviously, examiners are not managers of the bank, but I still think that there is a place for them to say, like, interest rate risk is on that Campbell's report, right? Liquidity risk is on that Campbell's report. And so it like kind of doesn't, if you think their math checks, the process by which they check their math also checks, but you're still saying like, I think this could be, your liquidity profile and your interest rate risk profile is such that you are more vulnerable or less vulnerable to this type of environment. Like, that's something you should communicate, even if it like nothing bad happens, right? I would rather say, hey, like, I guess as a referee, hey, you playing like this, you're aggressive man-to-man, that could probably get you more yellow cards than other teams. I'm not saying it's going to happen. I'm saying that, like, again, that approach is yours, and you can't be necessarily surprised by outcomes versus maybe a different team with a different style of play. I don't tell teams how to manage I don't tell coaches how to coach. I don't tell players. I have players, like, when they come up to me and say, hey, ref, that wasn't a foul, I look at them and say, okay, do it again then. Like, if you don't think it's a foul, then don't let me, who called it, change your mind, right? Like, but
don't let me change the way you're playing, but I'm going to call the game the way I see it, right?
I'm just calling it, and it's not personal. I've got to manage kind of like, I've got these other things to manage versus like, just adjudicating contact. But I think that I've been really curious about the effectiveness of examination, and I kind of, I want regulators to make a bigger deal about liquidity risk and interest rate risk before we have this. And I was really surprised and disappointed, to kind of think about what was I reading in these reports about what was and wasn't happening and where their attention was. Because, if the bank's not looking, that's, I guess one thing prerogative, but like the examiners are looking, like, like what are you, so yeah,
that's
was
the
just
whole
my
job.
rant.
No, I
hope that,
I think that's
we've
a good
really
one.
solved this one. I hope that we've solved the liquidity interest rate risk. Although I will say that I don't think most banks are still like really hedged. Like, there's a paper that found that like less than 10% of assets in the banking industry are hedged. And, First Republic's interest rate risk strategy included making loans at higher rates. So then you'd have a diversity of loans paying off at different times with different interest rates. And I was like, I don't know if I think that should count as an interest rate risk strategy. I think you should probably have some triggers that, if our EVE is telling us we have this amount of vulnerability to rates rising at 2%, we have an automatic hedge policy that goes into effect. Or if we want to offer these types of, we can only offer this type of credit in this type of environment, and maybe we don't offer interest-only $5 million loans in, like a 0% environment, right? Like, I don't know what they should have done, but I just kind of wish that they had been a little bit more automatic, and that regulators are probably like communicating that that's an option. So.
Well, I mean, what I hear you saying is there's the potential perhaps for interesting stories for us to talk about in the future. So, Kiah, with that, I will let you go. We will get, I'm sure, a fascinating 2024 that we'll be talking about all year, but it was great to catch up with you in the new year. Thanks for joining me.
Yeah, thanks for having me.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.